as entertaining and as deep as possible as well for those who are pretty much experienced. So what will we be covering today? Right, I'll be sharing with you guys a brief Forex history, okay, the structure of the Forex markets and who are the participants in the markets. And at the same time, we'll go through some of the Forex pairs. All right, so history of Forex, right, how Forex really came about. In 1944 in Bretton Woods, okay, in US, 44 of the world's leading nations actually came together to create a monetary system that they collectively agreed upon. And this became known as the Bretton Woods system, right? Or the Bretton Woods Agreement, okay? And this new system, okay, countries actually pegged their currencies to the United States dollar because at that point in time, the United States dollar was tied to gold, which that's why you hear this term being passed around called the gold standard, right? So what that means is you could actually, okay, take a United States dollar, all right, take $35 worth of the United States dollar, and you walk into the bank and you say, look, I want the equivalent in gold. And the bank has to honor that agreement, right? If you look on the notes, there's always this signature by the treasurer that says by legal tender, right? So the banks are actually required legally to give you the equivalent weight in gold if you were to walk into a bank with the US dollar, right? However, this legal tender doesn't really mean much anymore since the gold standard was dropped. But what really happened back then is that central banks would buy and sell their currencies in order to stabilize it within 1% of the peg level to gold, either to gold, the US dollar, or to gold. All right, so in the United States, okay, in 1971, all right, where this was actually after what you call I think this was shortly after one of the financial crisis. I think 1971 is just, if I'm not wrong, it's the Black October, right? There was an economic crash, okay, in the US. And in order to manage the dollar, in order to hold the dollar up, right, and not let the dollar price fluctuate so strongly with gold prices, okay, the US actually abandoned the gold standard and allow it to float, all right, against other currencies. So the US actually switched from a fixed peg to a free float exchange rate regime. Okay, there are multiple exchange rate regimes, but the one that we most commonly see is either a free float or a fixed peg. All right, Singapore doesn't use a free float, generally speaking. Okay, it doesn't use a peg, a fixed peg exchange rate regime. What Singapore actually does is they control the effective exchange rate, right? So that's why MAS always talks about the NEER band, right? The near band, right? So it's a nominal effective exchange rate. Okay, so Singapore's a bit different. All right, so yep, there you have it. Okay, and then by 1973, all nations participating in the Bretton Woods system agreed to allow the exchange rate to float against one another, right? So today, most currencies are freely floating, and their price is determined based on the supply and demand of each currency, right? So that's essentially how you get the Forex market. So what is the Forex market, right? It is, like its name suggests, a marketplace, okay, where currencies are traded or exchanged for one another. Okay, it's the world's largest financial market. All right, why is it the world's largest financial market? Because the daily turnover, all right, in 1998 was 1.7 trillion. And over the years, it has grown, right, to 5 trillion in 2015. As of 2019, if I remember reading, it was about $7 trillion turnover per day. All right, 7 trillion is really pretty huge. So what is the geographical distribution of the Forex market? Now, it is very interesting to note that sort of a fun fact, Singapore actually contributes to one of the highest daily turnover of FX trading. All right, I know our Singapore stock market cannot really make it. All right, I mean, we hardly have any listings, hardly have any IPOs nowadays. And even then, the stock market is not a very exciting and attractive place. But Singapore is actually one of the biggest FX exchange market in Asia. And we're also one of the biggest commodities exchange in Asia as well, right? So that's something interesting for you guys to note if you don't already know. So London, of course, has one of the biggest turnover, right? That's during the London hours, because London is really like the financial hub of Europe, right? So it takes about 37% of daily turnover. I think the percentages have already changed quite a bit. Okay, London is not that high anymore. I think it's somewhere about 32% or something. Okay, and Tokyo you have 22%. So in Asia, all right. Of course, here they put Tokyo, but really in Asia, the three biggest markets for FX is Tokyo, followed by Hong Kong, and then Singapore. I'm not sure about the percentage difference between Hong Kong and Singapore now, but previously Hong Kong was still having more FX turnover than Singapore, but I'm not sure about now, right? So of course, the third biggest will be New York. Okay, New York comes in at 19%, and Europe is just 8%. And then, of course, you have the smaller countries like Switzerland, Australia, rest of the world. All right. So how does the FX market actually operate, right? Because the Forex market is really a global market. And for those of you who know or have started trading, okay, it is 24 hours, 5 days a week, Monday to Friday. All right. Okay, it has no physical location. So this point here, okay, let me just bring out all the slides. Okay, it has no physical location. This point here is what makes the data for Forex a bit tricky. Right, so if you guys have been following me for a while now, I've always said that volume indicators never really work well on Forex. Unlike the stock market, because of the very nature of the FX market, right? So, normal stock exchange, you have a person, okay, buying a stock. All right. He goes to the exchange, okay, the exchange, to put in the order and say, look, I want to buy a stock of this company. Let's say this person is buying company XYZ. Right. So, regulation stipulates that XYZ will have to give to the exchange, okay, how much this person is requesting for, and the exchange will actually record it and give it to the person. So you get exchange fees, okay, there's exchange fees to be paid, right, both ways, the exchange earns, and this volume is recorded by the exchange and then it is reported. Now, the FX market works, okay, there's no physical location, the FX market works in what we call the interbank market. All right, normal people like you and I used to not have access to the FX markets. All right, I'll explain it a bit more in detail later, but just understand that if this is a bank, if this person is a bank, let's say this person holds USD, right? And he wants to buy Sing dollar. He actually has to go to a person who is holding Sing dollar, and they have to bargain and debate on a price until the price is reached, and then they will exchange with one another. Now, there's no middleman here. There really isn't any way that they need to report the volume, right? So how much they're actually trading, you don't know. You only know the price at which they agree to trade. So if this is Bank A, okay, or Bank of America, then this can be OCBC, something like that, right? So it's an interbank market, okay? So there is really no volume that is being reported here. All right. So let's move on. Okay, so we look at the timing of the market, the Forex market. Okay, so normally it starts with the Australian market opening first, right? Early on Sunday or early Monday morning. Okay, around 4 a.m. Singapore time, about there. And then after that, it overlaps with the Asian market, okay, which is the Tokyo, Singapore, Hong Kong period. And then just as Australia begins to close out, the Asian trading session actually overlaps a bit with the London trading session, which is around our 2 to 3 a.m. 2 to 3 p.m. depending on whether there is daylight savings. And then after that, the Forex flows over into a London session. Then the Asian session ends, right? And then the London session overlaps with the New York or the US session, all right? And then, of course, the US session overlaps with the Australian session. Now, at the period, okay, and usually at the open where they overlap, all right? Usually at the period where they overlap. Okay, these are the timings where the markets are the most volatile. Okay, just something for you guys to know. Okay, so the market structure, right? So how now we get to the structure. I already shared with you guys, there's the interbank, okay? And then there's the Forex brokers. So all these banks, right, they are actually exchanging FX with each other on a daily basis, right? On a daily basis. There really is no way we can tell how much they are actually exchanging with one another, right? Very interestingly, this is also where we get our LIBOR, London Interbank Offer Rate, okay? And based on that, if those of you who have HDB, okay, you take a loan from either the HDB or the bank, they always tell you there's a fixed percentage, okay, plus the floating rate of the SIBOR. And because the LIBOR that is determined by all these interbanks, okay, so you have Goldman Sachs, okay, you have Deutsche Bank. I don't think Deutsche Bank is one of the biggest now because they've been doing pretty badly over the years. You have Citi, you have JP Morgan, right? You have HSBC, okay, you have Stanchart, and then you have Credit Suisse. These are some of the biggest FX banks in the world, right? So they are the ones that generally determine the LIBOR. Okay, and if you check the news, okay, there is really a lot of LIBOR rigging around, right? Personally, in my professional experience, I've actually spoken to one of those guys that that was convicted, okay, for rigging the LIBOR. You can search his name up. I mean, he's serving his time over in the UK right now, but at first glance, when you look at him, okay, he seems very unassuming. He looks like one of those normal guys that you see in a kopitiam, in a coffee shop, right? Where he's just wearing a plain white t-shirt and khaki Bermudas and just Havaiana slippers, right? That's it, okay? That's it. But hearing his story was a bit scary and yet very interesting because at the height, when he was really manipulating the LIBOR together with his syndicate, he actually earned a year-end bonus of, I think, 128 million USD, right? And that was his year-end bonus, right? Some people don't even see the amount when they work for their whole life, right? But he's serving his time now. So, but having said that, I mean, it's wrong, but he's just a very unassuming guy. You would never think that a person like that was actually convicted of being the head honcho in rigging the LIBOR. All right, so the banks actually determine the exchange rate, okay? And then they give the exchange rate to the brokers, right? Because you cannot, as retail clients, we cannot go to the bank and say, look, I want to buy one lot of USD SGD, so to say, right? If any of you that have actually worked in the treasury department, you know that minimum, okay, banks trade with minimum $1 million, all right? Anything smaller than that, and it's $1 million USD, right? Anything smaller than that, they will not consider. Okay, so there's no way retail traders like you and I can go to the banks and do that. Now, the only time you can actually go as a retail trader, the only time you can actually go to a banks and do that is through a broker, right? through the broker. And what the broker does is the broker actually aggregates all the retail traders' orders, right? And this forms a large enough amount to meet the minimum requirement of a contract. And then the broker will actually get the price from the bank. And then the bank will tell the broker a price. The broker will give you another price based on its spreads. Okay? So that is how essentially it works, right? Unless you are a high net worth individual, okay? Unless you're a high net worth individual, then you have a special access to the banks through this thing called the prime brokerage. Okay, or prime broker, they give you better rates, right? But high net worth individual only, or you have your own family office, okay, or your own personal investing corporation, that sort of things. All right, so that's really how it works. Okay, so the third tier will be to the Forex traders, like I said, that's you and I, okay? Generally, retail Forex traders. So Forex market participants can be classified into 4 distinct categories. One is central bank, okay, or the government. One is commercial banks and financial institutions. All right, so central banks are run by the government, generally supposed to be independent from the government, right? But in Singapore, central bank is run by the government. All right, so financial institutions, so there's the commercial banking and industrial banking. And then you have the companies, right, like Apple, right? Why do they have to participate in FX market? Because they are selling their goods, right? Let's say in China, in the Chinese yuan, and then it has to be converted back to the USD for tax purposes and whatnot. All right. And then, of course, there are investors and traders or speculators. Okay. Any questions on the market participants on Forex? I don't think there should be any questions, okay, because that's really just a background. So Forex market works in pairs. To buy a currency, you sell its equivalent in another currency. The first currency in a pair is called the base currency. Okay. The second currency is called the quote currency. So in this event, this is the euro, this is the dollar. All right. So it will be called the euro. You're trading the euro dollar. All right. So this is the base and this is the quote. Now, one thing to note that the base currency is always $1. So what this means is if you buy Euro USD, you are saying that you want to use $1 of the euro to buy its equivalent in USD. All right, the same thing. If you want to sell the euro dollar, you're saying that you want to sell €1, okay, for the equivalent in USD. Okay, so that is how essentially it works. So this is an example here. Let's say the market price, okay, for euro dollar is 1 is to 1.13, right? So to buy €1, the base currency, you have to pay 1.13 USD. Likewise, okay, if you want to sell €1, you get paid $1.13 US dollar. All right, clear so far? Okay, let's move on. Okay, it can get a bit daunting, but do not worry, okay? So there are 7 major pairs, all right, or most traded currency in the world. Okay, the 7 most traded currency pairs in the world are called the majors. All right, so here we have the pair description and the nickname. So let's say the first pair, the first major is the euro dollar, right? So people either call it the euro or they just say euro dollar, right? And then, of course, the next other major is the dollar yen, right? So it's the USD against the Japanese yen. Okay, so they just call it dollar yen. Okay, and then of course, there is the pound against the US dollar. People either call it the pound dollar or they can call it the cable. All right, these are just some of the nicknames that have stuck around for the longest time. And then, of course, if they are trading the US dollar against the Swiss franc, right, they can say dollar Swiss or they call it the Swissy. Okay, and then, of course, there is the dollar against the Canadian dollar. So it's dollar CAD or the loonie. Okay, and then Aussie dollar, very simple. It's just called the Aussie or Aussie dollar. And then New Zealand dollar against the US dollar, they just call it the Kiwi dollar, or otherwise the Kiwi. Okay, so these are the 7 major currency pairs, okay, that people normally trade. So what are the features of the majors? Okay, they're very liquid, which means that there's a lot of people trading them. Okay, they are not volatile. I slightly disagree with this. Okay, you got to be careful about this. You cannot say that they are not volatile. All right, if you look at the nature of the dollar cat, right, the dollar cat tends to move sideways a bit and then suddenly it explodes. And then after it moves sideways a bit again and then it explodes. All right, that is the nature of the dollar cat. It is generally not volatile, but when it explodes like crazy and volatility rises quite a lot. All right, so I'll take this with a pinch of salt. Okay. Okay, they are hard to manipulate. Generally, the FX market is a bit hard to manipulate. Any manipulation, okay? Any manipulation, again, let me go back to the slides for you guys. Any manipulation, all right, will come from the interbank, the people that has the most control, all right, or the brokers. Okay, which is why it's very important to get a very good broker, right, that is actually licensed by a proper and respected financial, a country that has very strong financial rules and regulations. All right. Let me try to find where are my slides. Okay, so you cannot say that they are hard to manipulate. It can be manipulated, all right, especially by the bigger players. All right, tight spreads. Now, generally, tight spreads because of high liquidity, right? When people trade a lot, okay, it's easier to give you a better price from a broker's point of view. But if people trade it very little, like the exotics, okay, you don't really get such a good price. Okay, so we covered majors. Now let's move on to crosses. What are crosses? So crosses are currency pairs that do not involve the US dollar. All right, crosses, just think of it as the US dollar is crossed out, right? So there's no US dollar in the in the base and the quote currency. Okay, David, you're asking a question. Is it true that franc has some control either too high or too low? I think you're referring to the Swiss franc, right? Yes, the Swiss National Bank likes to actually manipulate the currency rate every now and then. Okay, I think about 6 years ago, the SNB actually suddenly cancelled its floating rate from against the euro, if I remember correctly. All right, memory is a bit rusty, and that really caused the Swiss to move like the Swissy to move like crazy, right? So yes, the Swiss National Bank does manipulate its own currency quite a bit. All right, so China also manipulates its yuan quite a bit. Okay, so that's something for you to know. All right, all currencies can be manipulated in some way. All right, think of it like this: if they cannot be manipulated, then central banks will not exist at all. Right, then there will not be so many LIBOR scandals around. Okay. All right, so back to this. Okay, so you see you have the base, currency, you have the quote currency. So this is euro against the Japanese yen, so we call it the euro yen, right? And then of course, if it changes to Kiwi dollar, okay, as the base currency against the yen, right? And we have the Kiwi yen, right? And then of course we have the pound yen, we have the euro pound, we have the euro franc, right? We have the Aussie yen, we have the Kiwi Aussie. All right. I think this one should be Aussie Kiwi, right? It should not be Kiwi Aussie. It should be Aussie Kiwi. Okay. So there's one thing that you guys need to know. It's called the FX pecking order theory. Okay. Always follow this convention, right? So the first one will be euro. Okay, followed by the pound. Okay, followed by the Aussie, followed by the Kiwi, followed by the USD, followed by the Canadian dollar, followed by the Swiss franc, and finally followed by the yen. Okay, so this is the FX pecking order theory. The top always gets quoted first, and then the bottom gets quoted last. So let's say you want to trade, okay, the yen and the Kiwi. Okay, you don't say yen Kiwi, right? It's always the NZD first as the base, okay, against the yen. Okay, so it's the Kiwi yen. So you have the euro yen, pound yen, Aussie yen, Kiwi yen, dollar yen, cat yen, franc yen. Okay, the yen is always at the bottom, right? And then of course, these are all the majors. If you're talking about Sing dollar, SGD, okay, or Malaysian ringgit, all right, or Korean won, okay, all these are known as exotics, okay, or rather, they're known as the emerging markets, okay, emerging markets. The emerging markets will always be quoted behind the majors, all right, these are the majors. Okay, so you want to convert Sing dollar to euro, you don't say Sing euro, right? It's euro Sing, right? Or pound Sing, Aussie Sing, Kiwi Sing, right? 1 pound will get you how much Sing dollar, 1 Aussie will get you how much Sing dollar. All right, that is how they do it in the naming convention. Okay, these are not covered in the slide, so this is just an additional point for you guys. Sorry, additional point for you guys. Okay, so what are the features of the crosses? Right, crosses are considered riskier than major pairs and known for the following features. They are generally less liquid than majors, that is true. Okay, they are more volatile. Yes, I will not say that they are more volatile, but they are more susceptible to wider swings in price. Okay, but that doesn't mean that they are more volatile. They can be equally volatile like the majors. All right, so easier to manipulate. Again, this one I take it with a pinch of salt. Okay, all the big players can always manipulate the prices. All right, which is why trading, as a retail trader, the game is really rigged against you right from the start. Okay, so, and the last point is true, because crosses are less liquid, there are wider spreads. Now we move on to what we call crosses between exotics. Okay, exotics are also known as emerging markets, okay, or EM. Okay, so you have countries like Malaysia, Singapore, China, right? These are emerging markets. Okay, it's interesting why there was a huge hoo-ha why people were saying, oh, China should not be considered an emerging market, right? China is still considered an emerging market officially. All right, they are not considered a developed market yet, which is why a lot of people are upset, right? That China is actually enjoying a lot of emerging market discounts and a lot of perks under the International Monetary Fund and the World Bank Group. All right. However, China is also developing really, really fast. Okay, so it is what it is, right? That is for the higher powers that be to go and debate and argue on that, right? Just some additional knowledge for you guys. Okay, so let's say we have the exotic pair, right? There's a euro and we're trading against the Turkish lira. So it's a euro try. Okay. And then let's say if you're trading the dollar against the Turkish lira, you have the dollar try. You always notice that the base currency is always one of the majors against the emerging markets, right? Okay, so you have the dollar against the peso and the dollar ZAR, which is the African rand. Okay, and then the dollar Sing and the dollar krone. Okay, I mean, a lot of people are quite krone, but my uncle who stays in Denmark, he says the proper pronunciation is actually a kroner, right? And then you have the dollar Hong Kong dollar. Okay, so these are just some examples of exotics. Of course, you have the dollar against the Indonesian rupiah and the dollar against the Indian rupee. Okay, really confusing because one is INR, one is IDR, right? So some of the features of exotics, okay, very illiquid, right? This is very true. Okay, you don't have people trading it very often. Okay, the only people that really trades this is the central banks itself. All right. Okay, very volatile. Generally, again, because the central banks trade itself, the prices jump all over the place. So that's why it is seen as volatile, right? And easy to manipulate because again, only the central banks trade it. And like we showed earlier, it's the central banks and the big banks that has the control of the rates. Okay, so generally it is easier to manipulate. And then of course you have huge spreads because of the illiquidity. All right. Any questions about majors, crosses, and emerging market exotics? Okay, no questions, then we'll quickly go through the next section. All right, so in this section, we'll learn, okay, a bit more of the technical details. What is a pip? What is a spread? What is a lot? How to calculate the profit and loss, okay? And types of orders. All right, so this is just something to take note of. So what is a pip or tick? Okay, let me just pull out all the thing. Okay, so over here you have the price, right? Oh, I never cleared the... Okay, so over here you generally have the price, okay? Anything that is traded against the USD or the crosses, anything except the yen, okay? The yen, as long as you have the yen is a bit special, but anything on the USD, all right, you generally see 5 decimal place, okay? It's not 4, okay? But, okay, you just understand that a pip, okay, is measured in the 4th decimal place. Okay, this is a pip. So what then is at the 5th decimal place? The 5th decimal place is called the pipette. P-I-P-P-E-T-T-E. Okay, the pipette, right? So it's smaller than a pip. Okay, so the 4th decimal place is the pip. Okay. So over here, you see, there's the 5th decimal place. Okay, there's 1.5 pips, all right, or 1 pip and 5 pipette, right? Now, for the Japanese yen pairs, okay, you'll always see something like only 3 decimal place. 1, 2, 3. All right. The pip is the second last one. Okay, so always remember the pip is the second last point, okay? Ignore the last number. The second last point is the pip. All right, clear so far? Okay, let me clear all this. Okay, so imagine the US dollar pairs and other currency. Okay, so this is something that I already covered. Okay, US dollar pairs are quoted in generally 5 decimal points these days. Yen pairs are always quoted in 3 decimal points. Okay. And now we already covered what is a pip. What then is the spread? Okay. Normally, we have this spread that the brokers always quote us. And that is how the brokers earn money, right? So let's say instruments are quoted in bid and ask prices. Okay, euro dollar. So the bid is the price to sell the instrument, right? And the ask is the price to buy the instrument. Okay, so the bid is the price which we sell to the broker. The ask is the price which we buy, okay, from the broker. Now, remember, it's always it's a bit confusing. Okay, so the bid we buy, the bid we sell to the broker, okay, which essentially means the broker, okay, buys from us. Okay, so the broker always buys at a lower price and the broker always sells back to us at a higher price. okay, because they are essentially doing a business, right? So the difference between these prices, the bid and ask, is the spread. And that is how the broker earns. They earn through the spread. Okay, so you have pound dollar, you have dollar yen. Okay, the spread over here. Okay, this is 1, 2, 3, 4. So for pound dollar, the broker will earn 2 pips. Okay, every time you trade through them, right? Assuming you trade on one lot. Okay, and gold, they will earn about 40 pips. Okay, and then of course you have cryptocurrency, you have the index, and then you have stock. Okay, stocks, we don't normally talk about spread. Okay, stocks, we will say they earn in terms of commissions as well. Okay, if the broker really always earns on the spread via stocks, then you should know that they will be able to manipulate the price. Okay, so how brokers or dealers or remisers or bank relationship managers actually earn money from you is, let's say you want to buy, okay, you want to buy euro dollar. Okay, so this is you buying, which means that the broker or the person or the RM is selling to you, right? So let's say this is the original price in the market, 1.1959, right? And you ask your RM, hey, I want to buy euro dollar. What is the price? Now, your RM, if they are very, very evil, okay, they will probably quote you 1.1979, something like that. Okay, so they actually earn, they don't even earn 1 pip, they earn like 20 pips from you, right? And if you are a private bank client, normally minimum you pay about a couple of $100,000, okay, for the exchange rate. All right, or you may, some rarer cases, okay, you may trade maybe tens of thousands of dollars only. All right, but the thing is, normally brokers earn this low spreads, but if your RM is going to quote you something so high, they actually earn a lot more and you stand to lose. Okay, so always remember the spread, okay, is always a sign of how much manipulation the broker is giving. Okay, so spread varies from one instrument to another. All right, but the principle still remains the same. Now we move on to what is a lot. Okay, so let's say for Euro USD, one standard lot that's traded is 100,000 euros. Generally, one lot is 100,000 bucks. Okay, now when you trade on the broker, okay, let me just bring up the MT4. Okay, so on the MT4 that you have, okay, for XM, there is this window here. All right, there is this window here called Market Watch. How to bring out all the instruments, right? You just right click any one and then you click show all, right? All the instruments that can be traded will be shown. Now, what is interesting also is actually, okay, what's interesting also is actually to right click and click spread. Okay, you realize there's an exclamation mark column. So if I right click and click spread, the exclamation mark column appears. All right. This 36, okay, let's say dollar Chinese yuan. 36 doesn't mean the spread is 36 pips. Okay, that's really big. All right. 36, it just means the spread is 3.6 pips. Okay. Now, if you look at the less liquid pairs, okay, the exotic like dollar, Turkish lira, look at the spread. 3861. Okay, the spread is literally 386.1 pips. All right, so it gets even higher when it's like dollar against the Russian ruble, right? 432 pips spread. Okay, that is crazy. But of course, if you have the major, okay, the major, the spread is really low, right? 2.3 pip spread, 1.5 pip spread, and euro dollar you have 1.6 pip spread. Okay, so that's how you check the spread, and that's how you get the prices to be shown all over here. Okay. Now, imagine if I want to trade the euro dollar, right? And my account balance has 105,281. Okay. Now, this is going to be crazy. If I trade one lot, right, immediately I'm using up 100K from my account, right? But how it works is the broker actually gives you a leverage. Okay. So you don't immediately throw in $100,000 worth of your cash. All right. So in Forex, one standard lot is 100,000. That's something to remember. Okay, and micro lot is 1,000 unit, which is 0.01. Okay. And in commodities, stocks and other instruments, a lot represents the number of units. So for gold, gold normally they don't say it's 100 ounce, okay? They will just say it's one contract because people trade the futures. Okay, so it's one contract, one futures contract. And one futures contract is about 100 ounce of gold. All right, so Bitcoin, you have one coin, all right, that's relatively new. Dollar, the US 500 stock index, okay, you have 1 unit, right? And stocks, you have how many units or how many shares as well. Okay, clear so far? So we move on how to calculate profit and loss. Okay, this should be relatively straightforward. Okay, so profit or loss is just the amount traded times the number of pips that you have. So an example is, let's say you buy one standard lot of euro dollar at 1.1358. Okay, they miss out the 5th decimal place because I think they just don't want to confuse you with the pipette and the pip. All right. So let's say you buy at 113.58 and then you sell at 113.73. Right. So you have made money. This is your profit. So your profit is about 15 pips. 1, 2, 3. Yeah, 15 pips, right? And then you multiply this number by the lot size that you have traded. Okay, let's say you trade one lot at 100,000. Your profit will be $150. Okay, so that is how you actually calculate the profit or the loss. So let's say this is the dollar yen pair. Okay, you buy at 110.5 and you made a profit of at 110.9. Okay, so you have a profit of 4 pips, right? So you multiply this 4 pips by the lot size, the standard lot size. Okay, you actually earn 40,000 yen, and then you convert it back to the dollar. Okay, divide it by the closing trade, 110.90. Okay, you actually earn a profit of 360 and 68. All right, so that's how you calculate profit or loss for the yen pairs. Now, very quickly, we move over to commodities. All right, so give me a moment. Okay, so commodities, let's say you have gold, right? Okay, profit and loss is calculated by amount traded times the dollar. So let's say you buy one standard contract of gold at 12.05 and you sell it, okay, for a loss, right, of 5 points. Profit and loss is calculated as 5 times the amount gain or loss, and that is the loss of 500. Okay, so it lost by 5 points. Okay. Now, very quickly, we move over to shares. Quite straightforward. Okay, shares. Let's say you buy at 117 for Facebook, and you sell at 178.1. Right, that's about $1.10 for every share that you bought. Right, so then you multiply the $1.10 by the number of share units that you have bought. Say 15 units, not 15 lots, but 15 units. Okay, so your profit is actually $165. Okay, so very straightforward calculations. All right. Again, this is for the indices. Okay, so just an example. Let's say you buy at 26.44 the S&P 500, and you sell at 16 points profit. Right. You just take 16 times the standard lot size. All right, that is the amount that you gain. Okay, so S&P trading contract is actually trading futures contract is actually requires a lot more cash outlay, which is why nowadays the exchange, they actually have they used to trade the E-minis, right? So you hear of the S&P E-minis. Okay, nobody trades the index outright. So there's the E-minis. Okay, but now to make it more accessible to retail traders, okay, they have the e-micros, okay, which makes it even cheaper to trade the S&P. Right, so with that calculation, I don't think that there's any issues. Just had to run through that quickly in the interest of time, right? Because I want to cover this thing that is more important, I feel. Okay, nowadays you go online, there's always this app, okay, or even the broker platform has a way to help you calculate the profit and loss. So you don't even have to really understand how to calculate the profit and loss, right? Okay, so with that, let's look at trading orders, the different kind of trading orders. So first and foremost, we have the market order, which is the most basic and common type of order. All right, it executes the trade at the best available price, or rather when it hit at the market, it means that you take what the market is giving you right now. So let's say you want to sell, right? If I hit at the market, okay, it means I sell immediately at that price, okay? So the bid price is the best available price to sell at. So you're selling to the broker, which means the broker is buying from you. Remember, the broker will always get the better rate, all right? And the ask price is the best available price to buy it. Okay, so you always buy at a higher price because the broker will want to earn more from you. Okay, so market basically very clear cut. It's just hitting straight at the market. What you see is what you get. All right. Okay, so you have now this one, we break it down into limit order and stop order. Okay. Just understand, don't be confused by sell limit or sell stop. Just understand limit order and sell and stop order. Okay, both of them, limit and stop, they are pending orders. Okay, they are pending orders. Now, what this means is that the orders will be there. Okay, the orders will be there. Okay, so let's say I have a buy limit. I want to buy when the price comes down here. I'm waiting for price to come back down to this level and then I'll buy. So what I have here is a buy limit order, right? This is a pending order that waits for price to come in. Once price comes in, taps this level, my order is immediately executed and then it goes up. Okay, I'm hoping it goes up rather. Okay, so that's a buy limit. So a limit order, in a buy limit order, okay, the pending order is below the current market price. Okay, this is the current market price, right? If you're talking about a sell limit, okay, you're talking about a sell limit, let me change. Okay, a sell limit, let's say I want to sell at a high over here. Sell limit order. So I'm waiting for price to come up to this level, okay, and then I'll sell. The order will be triggered and then price hopefully will go down, okay? So it's also a pending order, right? But you're waiting for price to reach that level, and that is the current market price. So that is a sell limit or a buy limit, okay? So there you have it, sell limit, price touches it, and then it goes down. All right, now let's cover stop order. So when a stop order, what does it mean? Okay, let's say I have a sell stop over here. Sell stop. What does this mean? This means that once price comes here and goes below, my order is executed and price should drop further. Okay, that's a sell stop order. Now on the opposite end, okay, if I have a buy stop order, same high, I'm waiting for a breakout, okay, a buy stop order. This is the current market price. Okay, I'm waiting for price to actually go higher, break above my buy stop, okay. Once it gets triggered, okay, price should ideally go higher. Okay, so the way to think about it is that a stop order, you're waiting for a confirmation. A limit order, you are actually waiting for pullback to enter at better prices. Okay? I'll give you guys an example. Let's say I'm looking at a limit, okay, sell limit. I'm looking at a sell limit, okay? Now, sell limit order will be over here, right? Let's say my target is I have a take profit at this level, All right, I have a take profit at this level at the recent swing low. Okay, this is my sell limit. Essentially, what I'm saying is I wait for price to come up to this area. I enter here and price goes all the way down to my take profit. Ideal world, price goes all the way down to my take profit. This is my reward. Okay, very huge reward, right? So I'm waiting to enter at a better price. And my stop loss, say maybe just above higher here. Okay, so my stop loss. Okay, now if let's say, and this will then be my risk. Okay, this will be my risk. Right, so risk reward, very nice, right? Now, let's say I have a, let me change to purple, sell stop order instead, okay? So I do not know whether price will pull back to the high and then immediately tank, okay? So I want a bit more confirmation. I will put a sell stop order below. Sell stop, okay? So I have the same stop loss, okay? Because if price breaks out to the upside, then I know my idea is invalidated, okay? And then I have the same take profit at a swing low. So price breaks below, then my trades get executed, and then it goes all the way down. Now, my reward is only like that. This is my reward. It's a lot smaller, and my risk is a lot bigger. Okay? But the good thing is I have a confirmation. All right, so there is a difference between sell limit and sell stop order, okay? Sell limit, generally, limit orders, you generally use it when you're a more experienced trader. Okay, stop order is for people who are not sure, but they just want to have an additional confirmation. In this case, it's a confirmation of a breakout to the downside. All right. Over here, okay? And then you have your initial stop loss at this level, right? So the trailing stop will automatically throw your stop loss when the market moves in your favor. But if the market moves against you, it will maintain its level. So an example will be, let's say you have a trailing stop of 20 pips, okay? Price moves up, the trailing stop moves up and holds here. Price comes down, the trailing stop still stays stagnant. Now price moves up, the trailing stop continues and follow up. Okay, it holds here. When price comes down, okay, the trailing stop doesn't change at all. When price goes up, okay, the trailing stop continues about 20 pips. Okay, if you're trailing 20 pips, okay, I don't think this move is definitely more than 20 pips. So the trailing stop should be somewhere here, right? So when price comes down, okay, you will have been stopped out already. This trade will have been stopped out. Now, from the time that you buy to the time that you stopped out, okay, this is your reward. Okay, so trailing stop actually helps protect any sudden moves against you. Okay, and it can also help you take your mind off the market where you don't have to monitor it all the time. All right. Okay, and we move to the last portion. Okay, very quickly, really, there's not much time. Such a lot of theory. They should actually break this session into two. Okay, so you will learn about cash account, margin accounts, leverage, what is margin, and what is margin call. All right, so I will try to clarify with you guys as clear as possible. Cash account, you don't need to think so much, okay? Cash account basically means the buying power is equivalent to the amount that is inside the account. Think of it as your normal bank account. You only have $100,000 inside. You can only buy things up to $100,000. That's it, okay? That is cash account. Margin account basically means that, okay, the bank is willing to lend you more money, right? So let's say you have $100,000 inside, you want to buy a house, okay? So the bank will just tell you, okay, never mind. You fork out maybe 100,000 and I'll top up another 400,000 for you. Then you can buy your house, something like that. Okay. So that is the difference between a margin and a cash account. But one thing to note is that margin account, let's say you buy a house, right? And your house somehow or rather, okay, in a very funny world, not in Singapore, okay, your house actually depreciates in value. So your total cost, okay, you have 100,000. Bank lends you 400,000, okay, to buy your house, which is worth 500,000. Okay, the value of your house drops, okay, to 450. The value of your house dropped by 50,000. Okay, now at the end of the day, the loss comes out from your account. You are down 50,000. Okay, so you left 50,000 in your account. You still have to return the bank 400,000. All right, so that is how a margin account works. Okay, and essentially speaking, if let's say your account, all right, if let's say your house value, okay, let's say your house, give me a moment. Let's say your house, okay, 500,000 value, right? Your house 500,000, it drops, instead of drops to by 50,000, it drops by 300,000. Now your house value becomes 200,000. Okay, it's clearly more than $100,000 that you have, right? In fact, it nearly wiped out everything. Now the bank doesn't want to take losses. Okay, what the bank will do is the bank will call you and say, "Hi, sir. Hi, madam. Okay, your bank account has dropped by so much, right? It's nearing the negative now. Please top up." Okay, that essentially is a margin call, and you have to top up. If you don't top up, the bank will take back your entire house, okay, and they will sell it on the market, right? So that is essentially how margin call works. Okay, I'm just trying to condense it in the interest of time. Okay, so what is leverage? Leverage is essentially a loan that's provided by a broker to the investor or the banker to the investor. Okay, and you have different leverages, all right? There's 2:1, 3:1, all right? Singapore law stipulates that maximum you can go is 20:1 unless you are an accredited investor. Okay, you can actually write into the broker and ask for higher leverage. So MAS is very strict about it. Okay, so 20:1 is going to be a bit hard to trade. All right, brokers that lend you 500:1, unless you really know what you're doing, this is going to be quite risky. Okay. Okay, Amanda, you have a question for the CFD account. It will close the position automatically when free margin drop to negative. Yes, generally speaking, if your broker, generally, okay, it really depends on the broker. Some brokers are nice. When your free margin drops to negative, they will tell you, "Hi, please top up, please top up, please top up." Okay, and if you fail to answer their margin call, if you fail to top up your account, all right, they will immediately close your position. All right. So some brokers are like that. Other brokers, there are brokers that do not even give you a warning. The moment your free margin drops to negative, they don't even margin call you. They just send you a notice to say, your margin is now negative. We are closing out all your position, because the brokers have to protect themselves. So they'll just close out all your position. Whether you have, let's say you have multiple positions, okay? 5 positions, 4 of them are winning, but your last position, your 5th position is actually causing a lot of losses. But you know for sure there's going to be a positive trade. You just have to wait for it, right? Your broker doesn't care. They'll just close out all your positions anyway, all right? So always be very careful about the margin level. Okay, so very quickly, how to check the margin level, all right? Don't have to worry about the free margin, okay? Do not have to worry about free margin. I'm going to sacrifice my demo account for you guys, okay? Do not have to worry about free margin. Let's say pound dollar on a 1 hour. I'm just going to enter a trade, okay? I'm going to, because I don't want to sacrifice my account too much for you guys. Let's say I enter 5 micro lots, okay? I will sell, okay? I sell at market, right? Immediately, look at that. Loss in profit. Why? Because of the spread that I was telling you guys, okay? Now, more than that, okay, look at what happened to the, look at the margin level. Okay, the margin level right now shows all this, some blah, 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 something percent. Okay, now to be safe, to keep you guys safe, always have your margin level about 200 to 400%. Okay, so you don't have to worry about your free margin, you don't have to worry about your equity, don't need to worry about your balance. Okay, don't look at all that. Just look at your margin level when you have trades running. Make sure they are within the 200 to 400%. Okay, I think pushing it is about 100%. Okay, anything less is really, really risky. All right, so this is just a way to monitor your margin, okay, and not to over leverage your trades. Okay, so an example of 100:1 leverage means if you deposit 100,000 in your trading account and you choose to trade with a leverage of 100:1, you can trade up to 100 times of 10,000, which means you can trade up to $1 million US. Essentially, you can open, okay, 100 lots. Or is it 10 lots? 10 lots, sorry. You can open up to 10 lots worth of trading position. All right, that is how it works. All right. So just got to be careful about leverage. Okay, so just maximizing the profits and losses. I'll just briefly go through this. Let's say you have an initial deposit. First scenario, the initial deposit of 10,000, and you choose a leverage of 100,000. What this means is your broker allows you to trade up to 1 million euro. Let's say you buy a euro dollar at 113 and you sell at 114 with 100 pips profit. Okay, this would mean that then you gain 100 pips on 1 million is 10,000. Your account literally doubles. Okay. Scenario 2, same thing, same leverage, same trading capital, but this time around you sell for a loss. Okay. So you sell for 20 pip loss. All right. And you lose $2,000. Remember, I say that the losses come from your account first. So the $2,000 will be deducted from your initial deposit of 10,000. You are left with 8K. $20,000, the free margin is 10,000. Okay. Essentially, what it means is the account balance has 2 times of the free margin. Okay, so you generally have a buffer of 200%, so to say, right? Which is why I say 200% is a safe number to look at. Okay. Same thing. Okay, so this is really risky. Let's say you take a loss of 10,000, right? Your account, now you only have 10,000 left. Okay, your required margin is 10,000. You only have 1 time your required margin, which means that really if you lose, you start losing. It's going to be very hard to climb back up, and anytime soon you might get a margin call. All right. So when your margin reaches 100%, you don't have any free margin to open a new position. And generally speaking, margin call is at 50% level. All right, you need to go and check with the broker, okay, with XM, what is the margin percentage that they have for you. Okay, and then they will force close you at 20% margin level. All right, so this way, both the broker and the investor will be protected and prevents them from losing more money than initially deposited. All right, I hope today has been a very informative session for you guys. Just trying my best to, I know it's a very lengthy, a lot of theory, a lot of background, but I'm just doing my best to give you guys a proper understanding. For those of you who are more experienced, thank you for staying through all the way. All right, I hope I managed to value it in some way. For those of you who are really brand new, I hope you also managed to learn a lot of things along the way. Right, so I will catch you guys for the webinar tomorrow. We have a live analysis. Please trade safe, not because of the coronavirus, but because the US elections tomorrow. The results, I think, will start coming in tomorrow. All right, so wish you guys all the best. Catch you guys tomorrow. Take care and have a great afternoon ahead.